Well, let's get ahead of the market open now. We are joined by Scott Phillips from the Motley Fool. Scott, welcome to Friday. Wow, what you take a look at the local index. Have you ever seen volatility like this day to day?
A crazy week, wasn't it? We saw big ups, big downs, backwards and forwards. I mean, have we seen it? Yeah, kind of. But normally in times of real crisis or real kind of existential or current concern, this is not that. This seems to be pure sentiment. It kind of comes down to how bad might things get. And we've gone from terrible to wonderful, terrible to wonderful, and back again. The US hitting highs, of course, during the week on the way through all that. So yeah, there's a lot going on. Maybe more for Australia than the Yanks, just because of our minerals exposure in particular. But it's been a remarkable week. I don't know if every day was more than 1%, but it might have been. Two ups, two downs. It's getting a little bit silly. I mean, markets do what markets do, right? So it just is what it is, and you roll with the punches. But when you kind of infer the meaning of that, which is investors, traders in on and on the given day are excited and miserable back and forwards, it does remind you that there is people guessing about what's going on, particularly in the short term. Frankly, for long-term investors like me and others, it's a nice reminder to ignore the noise, because at the end of the day, businesses aren't worth 1% more than 1% less than 1% more for the full value of their cash flows over the fullness of time. So yeah, it's been all over the place, mate. But that's kind of markets, right?
It is indeed. So, Scott, let's just focus on some stocks that are moving. In fact, we take a look at Guzman and Gomez. That jumped yesterday. Look, consumer discretionary clearly in focus, given what we're seeing more broadly, particularly cost of living pressures and the like. It is out with an update this morning. What are you seeing?
Interesting enough, they decided to pull out of the US market, Andrew. And you know what, we kind of give, hindsight bias is pretty big in society in general, and even in the financial markets. It was a really gutsy call to try and take Tex-Mex from Australia to the US, where they just have a million different options. I mean, literally, they're on the border of Mexico, right? I mean, it's an aggressive decision. On one hand, you say, well, the market's available and accessible. They're prepared to have Mexican in particular. Maybe we can take it to the US and be successful. They tried the East Coast, which I thought was smart. The West Coast is absolutely saturated, Chipotle Mexican grill in particular, but plenty of options. So they gave it a go. Now, as I said, I thought it was a high risk. I didn't think the probability of success was particularly high, but it's worth a shot, right? And the better thing, I suppose, now is they've gone, yeah, it's not working. We're going to close it down and come home. And that takes some guts, takes some, putting the ego in the back pocket and saying, no, we thought we'd make this work. We're going to have egg on our faces. We're going to cop it because it's the right thing for the business. So I don't know if this is necessarily textbook, but it's a pretty good example of making some little bets, seeing if you can make them work. And when you kind of realize you can't, you shut up shop, you come home, you wipe the money off. I mean, the money being written off is no great thing. And there'll be plenty of Monday morning quarterbacks today say, oh, of course it was never going to work. No, as I've already said, I didn't think it was. But that's different from, oh, it was never going to, right? So you're worth a go. And of course, some of those bets do pay off and you go, oh, of course it was going to work. So investors really, we need to check our egos when it comes to these sort of things. But the company, I think, as I said, not exactly textbook, but pretty close. Small investment, see if you can make some growth, give it a red hot go. And when it doesn't work, like I said, come home. Say don't throw good money after bad. Well, that was a really, really impressive part of this one. It does, though, raise questions about Guzman y Gomez's growth strategy. Because now you've got to ask yourself, right, if that's not a growth option, we know how big the US market is, what's left? Now, there's going to be growth here in Australia. There's going to be growth in other places probably. But that was the big bet. And I think as an investor, you're looking at it now saying, right, I need to resize my expectations. This is now an Australian business predominantly. The value is going to be here. The growth is going to be here. But also at some point, that growth simply nets out. I mean, there's a Guzman on most street corners these days. So as I said, of course, there's room for new stores. But it is now a question of what does the new strategy look like? Do they go to kind of a bit more growth, but maybe a bit more cash redemption for shareholders? What does it mean for the share price and the valuation? We'll see that play out in the market today.
Yeah, dare I say that appetite for its products certainly dramatically reduced. And perhaps we should have seen it, as you said, Scott. It was like Coles and Newcastle or selling ice to the Eskimos, wasn't it, as far as its US strategy is concerned. Now, elsewhere, focus on consumer discretionary, particularly in the travel sector. We know the pressure that's been under. And look, this week, Webjet also hit, particularly as far as Virgin Australia cutting its commissions.
Yeah, this is interesting too, mate, because if you think about what Webjet is, particularly in the domestic market, there's two airlines. I mean, there's a couple of brands. Yeah, there's Rex and there's others. It's Virgin and Qantas, right? Excuse me. Maybe to some degree, it's a surprise that Virgin cut earlier. Because here's the thing: if you're a comparison website and you've only got one of the two major airlines, you're not a comparison website, and that kind of means the money is in the whip hand is with the airlines, not with the travel agent. If there's 15 airlines, you need to be there to compete. If there's two and you're not there, the travel agent themselves, the comparison website, is the one that's struggling. So it. My apologies, mate. I've got a cooked throat today. The comparison website needs Virgin more than Virgin needs Webjet, and that's the real challenge. So Virgin coming along saying, we'll cut your commissions. What are Webjet going to do? They're not going to pull out. They're not going to only offer Qantas flights. Otherwise, you go straight to Qantas instead. So they really are in a very, very tight spot. Now, they released travel bookings that were pretty much dead flat. So you start with flat bookings. You reduce the commissions you're getting from an airline. That only goes one direction, and we saw the shares fall as a result. I think the Webjet business itself is sound, but again, when you know that the airlines can pretty much charge whatever or pay whatever commissions they want to, absent that, what else does the travel agent do? It really does make Webjet a very, very difficult proposition. They are reliant on those airlines in particular. Now, yes, they've got hotels. Yes, they've got packages. There's other things they offer, but realistically, we know domestic flights are the vast, not only the bulk of their business, but the reason most people go there, right? Take that away, and you haven't got much reason to go to Webjet's website. So they've pretty much got to accept whatever Virgin and Qantas want to offer them. Virgin's pulled out. So it's a tough road to hoe. And again, we don't expect that consumer discretionary spending, travel in particular in the consumer sector, picks up anytime soon. And if you're Webjet, that's where you are. You're in the consumer sector. So different from corporate travel management, air management businesses. So Flight Centre's corporate business, corporate travel management itself, I own shares. It's corporate business. That's a different story. They're not entirely disconnected. But yeah, consumer spending is doing it tough. And that's unfortunately what Webjet are sailing right into, or flying into, maybe I should say. And those reduced commissions make it much, much harder for them to make a buck.
And Scott, just briefly, take a look at the US market. Obviously, maintaining that strength. They're very much focused this week on Nvidia's results, of course, but also we've got this IPO frenzy coming up as well. SpaceX, OpenAI, Anthropic. There's a lot of money to be spent there. Interesting to see how that's going to play out.
These are astonishing numbers, mate. Let's start with Nvidia's numbers. 85% revenue growth. It was $86 billion in a quarter. These are stupidly large numbers, growing like topsy, just incredible. And of course, 5.4, I think, trillion US dollar, more than $7 Australian trillion dollar market cap. It is just an absolute behemoth and a wrecking ball right through this industry, doing amazing work. And then you look at the IPOs now. Markets hitting highs, of course, that's exactly when you want to get an IPO out there, right? When everyone's feeling good, when prices are high, when optimism's in the ascendancy, yeah, you're absolutely going to run over people to get to the market first. So we are seeing, as you say, a couple of AI players plus SpaceX come to the market. SpaceX has lodged its own prospectus, looking for $1.5 trillion. OpenAI owns ChatGPT, of course. The last valuation was, I think, just short of $1 trillion. If you're going to list, you're not going to list at that price. You're going to list at something higher than that, so probably another $1 trillion. And here's the other thing with for some context. OpenAI is going to spend $1.4 trillion US dollars over the next few years on AI infrastructure. $1.4 trillion. It is an extraordinary amount of money. And then they are the leader, but then, as you say, you've got Anthropic that owns Claude, you've got Gemini from Google, you've got Grok from Twitter, plenty of others besides. They're all investing in their own infrastructure. This is an absolute arms race. Now, on one hand, you say, great, good news for Nvidia. We saw that. Good news across the board for infrastructure, data centers. That's great. On the other hand, I can't help but just be a little bit mindful that there is so much going on here. Is some of it going to be wasted? Almost certainly. Does that mean some of the valuations might be hard in aggregate to support? Probably. I mean, who knows, right? Other Facebook was overvalued when it listed, and I was dead wrong. So there's been great and terrible companies listed on the US stock market. Some of those valuations, though, require everything to go right. And if it does, great. If it doesn't, there may well be a case to look out below. So just tread carefully when you're looking at these new IPOs. Everyone's excited about AI. Everyone's excited about satellite internet and self-landing rockets. And the tech is amazing, like just across all those businesses, right? But that doesn't necessarily mean the price is right, particularly when there are other players in the space, whether it's Jeff Bezos' Blue Origin competing against Starlink, for example, for low Earth orbit satellites, whether it's those other AI players, as I said, who knows where this one nets out. Maybe ChatGPT is the Facebook of AI, maybe it's the MySpace of AI. We just don't know how that trend will play out. Just make haste carefully is probably a good bit of advice, I think.